Smart money has been using the same playbook for decades, yet 95% of retail traders still fall for it every single day. I'm talking about liquidity sweeps. After 11 years of trading and generating over $11 million of trading profits, I've learned when to spot these traps before they even happen. While most traders are getting stopped out at the worst possible time, I'm entering my trades with perfect timing. Today, I'm pulling back the curtains on how institutional traders are engineering these sweeps and how you can spot them before they even happen. This is the exact framework I use every single day to stay one step ahead of smart money and broadcast live to all my paying students. Now let's talk about liquidity, what moves the markets. Definition of liquidity areas. What is liquidity? It's simply money. Imagine money exchange from one end to another that is giving life or blood flow through the markets. This is what the markets run on, and most of it is caused by banks or institutions providing most of the liquidity. They're the big whales in the markets, moving the waves up and down, and we're just a small fish trying to follow along. Without liquidity, the market would not be as volatile as it is. There would be no price changes if there's not a lot of money, billions and millions of dollars coming in and out, exchanging price. Liquidity is one of the hardest concepts to understand. But once you master it and learn how to use it, you could improve your trading a ton. Identification. High liquidity areas typically found around major support and resistance levels and previous highs and lows. Blocks. Zones where large volumes of orders are executed, indicating institutional activities. Now, how does this actually help us? We understand liquidity is money. How can we use it for trading? Trade entries. We enter a major liquidity pool to look for an explosive move the opposite way. The way that you see those big move down and then V-shapes right back up. More likely, you entered a major liquidity pool that was sticking out and give price a little strength to move to the opposite direction. Wouldn't it be nice to know when that happens so you can apply to your trading to catch massive moves? Well, this is exactly what liquidity is going to teach us. Risk management helps understand where low/high liquidity areas are located and can also be used as a stop loss area or areas to take profit. Helps us time the market. We've heard it before, you cannot time the market. Well, I'm here to tell you that you can if you understand liquidity. Helps us avoid trading your low liquidity/chop. Used to build a plan around them with other confluences in key areas. We need to understand the difference in liquidity. Liquidity grabs/sweeps when price takes out liquidity area and creates a V-shaped recovery. When price retraces to these areas, we do not want to trade off of it. It is very dangerous, but only use it for the sweep to then find a confluence entry to continue that trend after the sweep happen. Liquidity form when price hits a key area and starts to go sideways/build up a liquidity before making a move. You can imagine this as a supply area or a demand area later on. If you understand the stage of liquidity you're in, are you within an internal range liquidity, an IRL, which is liquidity created in a range that is taken out to continue the overall target for the price to reverse. These will be your pullbacks then to continue to overall direction versus your external range liquidity, your ERL, which is liquidity has been created on larger time frames typically and price is delivering to then reverse. If you understand where your ERL is, that's when you can look for reversals. While your IRL is when you're going to be able to continue the overall trend and not get freaked out in a big reversal. Let's look at IRLs versus ERLs. You can see on this larger time frame we have price go sideways. Our external range liquidities becomes the highs and lows are within outside our range, while our internal range liquidity becomes the highs and the lows that are within the range. Now you want to avoid trading within the range and you only want to look for a trade after one of the internal range or external range gets taken out. As you can see, as price goes sideways, we have a candle close above the IRL and then right back below, taps it, closes below, and then we finally have our explosive move to the downside that comes and takes out the external range and gives us another V-shaped recovery back up. And now that the IRL was already taken out, price goes straight up to the external range liquidity. Guys, what's important to understand here is a lot of times you want an explosive move to one of these liquidity zones, because when that happens, you're gonna get your V-shaped recovery. It's important to, you're not entering just because a lower high gets taken out, and I see this mistake all the time. People just, hey, low's taken out, let me enter. No, you're waiting for the closure back above the lower the high, the external or internal range liquidity higher and low, and then looking for a trade after it. But it makes you understand where you should be entering your trades. If we look at all of this middle zone, there's a ton of chop where a lot of traders are getting stopped out because they're not understanding where the liquidity actually is. And then as soon as the liquidity gets tapped into, that money flows into the markets, the stops get hit, people enter the trades, the big moves happen. And those, let me ask you, do you want to take a trade during this choppy periods, it's going sideways, or do you want to take a trade when finally price gives you a clear direction? You need to understand the importance of time frame. One of the biggest problems with understanding where liquidity is, it is to work the time frame. If you're expecting price to deliver at a bearish external range liquidity, wait for your lower time frame models to show you bearish setups that will drive there. Look for where the internal range liquidity should be formed, oftentimes your golden pockets, then to look for higher RR entries towards your goals. So if I'm looking for this external range here to get taken out, when price V-shapes back up, now I'm looking for bullish only trades back up to this equal high external range liquidity. If we take a look at the example I just showed you guys, we can know how price move after taking out the levels of liquidity. Knowing how now, once you take out your internal range liquidity here, the bearish fair value gap gives you a clean move to the external range. While before, during the chop, these bearish or bullish fair value gaps just weren't doing much. You need to wait for the liquidity to be taken out to then actually use the confluences that you know to look for the trade. Look at this bullish IFVG inversion fair value gap gives you a clean move as soon as the external range that was bearish gets taken out. And this is the importance of working those time frames. Let's zoom it a little more in. Let's really dissect what happened here. This is on a 15-minute time frame. We have our external range, internal. And we have to understand that time is fractal. So if the 4 hour is showing us chop, external, the 50 minutes, 5 minutes will all show you the same. This is why you start on the higher time frame and you work your way down to the lower time frame. We can easily analyze where is the chop no trade zone versus looking for our bullish and bearish point. We only turn bullish, guys. You see down here, we're not turning bullish as soon as the low gets taken out because price could continue lower. You need to wait for those confirmations to then actually take a trade off of. Because if price is only moving from external range to external range, we'd be going sideways forever. At some point, this liquidity will be taken out, then tested again, and price will continue, which is trading a breakout. So we're turning bullish when price flips back above that low or back below that high. Now, and then from that point on, you're only looking for bullish setups or you're looking for bearish setups. And that's how you build a bias in your trading. You build a bias by using liquidity. You can also use your external range and your internal ranges within your AMD. Your internal range liquidity should be where you find your manipulation moves more often than not. Price will chop up, then take an internal low, then finish distribution to the external low. If we look at this example, price chopped up, created a fake move that took out its internal range liquidity and backed down. Now we can also look at the opposite on this larger time frame. Price chopped up, took out the external and then flipped back above. So whenever you take out liquidity, more often than not, you're creating a manipulation back to the other side. We can look at some different example. We have an overnight session. We have external range liquidity, which is crossed about the high, and internal range liquidity, which is the latest low that had not been tested. Now, an external range will tend to be outside of the trend. So since price is bullish, your internal ranges will be lows and your external ranges will be highs. We have price open up in 930, big move straight into the internal range liquidity low. Price fails to close below it, closes back below it, and we activate the 10 a.m. reversal. This is when price strongly closes back above it, aiming for the external range liquidity, which is your overnight session high. In this case, it was an Asia session high. Then price, again, takes out the range, comes back down, creates a bearish IFVG there, and we can find a clean entry when that gets retested with a golden pocket for a high confluence trade to take the trade back down to the downside. And this is, guys, how you're combining everything, the puzzle that it is, your confluences, understanding liquidity, understanding golden pockets. It's all a big puzzle that you need to put together, find a proper setups just like this. Just because you have the lows and the highs marked out, it is not good enough to make actual proper trades. Now let's talk a little bit about equal highs and equal lows. If you think liquidity is great, equal highs and equal lows is essentially a Super Saiyan version of one liquidity low. One of the easiest way to spot liquidity needs to be taken out is by looking for equal highs and lows. These will oftentimes be looked as support and resistance areas as well. Price aims for equal highs or lows to trap breakout traders if they think a key level is lost/gain, to then collect their liquidity and move price in the opposite direction. If you ever wonder why price came to your stop loss and took you out of a trade before then going the right direction, more than likely you were the liquidity the market seeked. A really clean example here, we have a 15-minute equal lows from the pre-market. Price will use this as a strong magnet. When I take it out, close back above it, V-shape back up for the external range. Now let's look at more example. Equal lows, relatively equal lows to the left, taken out, AMD back to the high side, and then we have equal highs that are formed on the opposite direction. Price takes them out and then directs the other way. So look at it as your internal range and your external range, but with added importance, your Super Saiyan versions of regular liquidity sweeps. How do we actually trade them? Equal highs and equal lows that manipulate are always soups or fake breakouts. Do not enter when you first break a high or a low. You do not right away if it will work, so you do not want to find yourself trapped in this position. It works best when you're looking for an AMD. Most AMDs will also have equal highs or lows when looking for them. Looking then for your re-entries, golden pocket, fair value gaps, when price displaces back under the lows or highs. These will confirm large orders were trapped. The bigger displacement, the larger the move the opposite direction will be. Things to keep in mind, guys, do not go short or long into wicks that took out of liquidity. If a wick took out of liquidity, it does not mean it's now liquidity. If liquidity has been taken out, the candle that took it out is not of importance. You can ignore that. As you can see here, with these equal lows, this candle takes it out. This does not become a supply or demand area. This becomes irrelevant. As you can see, price just displaces through it. It does not care for it. A lot of people think because it's taken out liquidity, that long wick now is of importance. Guys, please do ignore it. Some more notes is liquidity is one of the top concepts you have to master to find true success in trading. Yes, it works in all time frames from the 1 minute up to the monthly. Always line up to larger time frame bias to find the highest probability setups. Price will move from one key liquidity to the next. Liquidity sweeps fight the trend, so you have to be careful and you have to be precise when you're trading them. Now let's look at an example that I used in my trading on Thursday with my trading group. We had a strong move to the upside, so I understand, hey, we had a big move to the upside. We're gonna have two key liquidity levels to look for, which would be the pre-market high, and that will be an external range liquidity, and we're also gonna have to look for the internal range liquidity, the sideways period that price has created, to then look for a move to the upside if we wanna continue the overall trend. So I will mark out the key low and the key high. The reason why I'm marking out this low here is because this one was right when the market opened up. So the lowest point I will add and I will put in, this is my internal range liquidity that's sitting right below all of this chop. And then this will be my external range liquidity, which is sitting right above all of my chop, but because it is the opposite direction, it's a bearish trend, it will be an external range. Then I wait for price to give me a move. 9:30, we're opening up between what are no trade zone. So between this, we are not trading, guys. Price went sideways. Why do we want to take a trade during that? We don't. We wait for price to take out either the high or the low. In this case, 9:30 opens, 9:45, big move to take out our low right here. Then we stay patient, we wait for this price to close back above 10 a.m. We get a nice 10 a.m. reversal. We see a buy model back to the internal side. If we jump to the 5-minute time frame here, we see that we have a nice entry with our Fibonacci retracement. We take our Fibonacci from the low that took it out to the latest high, and we see price retrace right to our golden pocket. When price closes above the golden pocket, we can simply enter, have a stop loss at closure below the golden pocket, target the external range, and that becomes a beautiful trade. Positive risk to reward, about 1 to 3.42 in price, even kept going above. This is how you combine everything from the larger time frame to the smaller time frame to liquidity to your other confluences to find winning trades and finally turn profitable in 2025, hopefully. Now you understand why most retail traders consistently lose money while smart money profits. They're not smarter than you, they just understand how liquidity drives the markets. If you want to see me identify these setups in real time and learn how to spot them yourself, you might be interested in my mentorship program. I work with a small group of traders who are serious about mastering these concepts. The link is in the description below if you're interested. Thanks for watching, and I'll see you in the next one.